You're standing at the gas pump, watching the numbers spin, and somewhere between $42 and $43, you get this tight, uncomfortable feeling in your chest. Not panic, not yet. More like dread. Like something is off and you can't quite name it. You tap your card. The pump beeps. You drive away. And then you swing by the grocery store, and you grab what you always grab. The same bread, the same eggs, the same olive oil you've been buying for years. And somehow, it's $15 more than it was 2 months ago. Nothing changed. You didn't buy more. You didn't buy anything fancy. It just cost more. And you're starting to wonder, is this ever going to stop? If that sounds like you, I need you to stay right here, because what I'm about to show you is not just going to explain why that's happening. It's going to show you exactly what to do about it. And I mean exactly. Not vague advice. Not diversify your portfolio. Real, specific moves you can make in the next 48 hours to protect yourself from what is coming. Because here's what nobody is telling you. The US-Iran conflict, the one you're seeing on the news, the one that looks like a foreign policy problem, a political problem, a somebody else's problem, is already inside your economy. It's already sitting inside your gas bill, your grocery receipt, your investment account, and your mortgage rate. And most people have absolutely no idea. They're watching the headlines like it's a movie. But this isn't a movie. This is your money. And if you don't understand what's happening, you're going to keep feeling that tight, helpless feeling every time you tap your card, until it gets a whole lot worse. So today, we're going to fix that. I'm going to walk you through what is actually happening with Iran and why it matters to your wallet. I'm going to show you the real financial chain reaction that most mainstream media completely skips over. And then I'm going to give you the playbook, the actual steps, to come out of this smarter, safer, and maybe even ahead. Let's go. All right. Quick geography lesson. And I promise this is the only boring part. There is a narrow strip of water between Iran and Oman called the Strait of Hormuz. It's about 21 miles wide at its narrowest point. That's narrower than some rivers. And through that tiny, 21-mile gap flows roughly 20% of the entire world's oil supply. 1 in every 5 barrels of oil consumed on planet Earth passes through that strait. Every single day. Think about that like a highway. Imagine 20% of all the food in America had to travel on a single two-lane road. And that road runs right through the backyard of a country that is currently in a standoff with the United States. That's what we're dealing with. And the moment there's even a whisper, not a closure, not a war, just a whisper, of that lane being disrupted, oil markets go haywire. Because oil traders don't wait to see what happens. They price in fear before a single barrel is touched. Now, Iran is not a small player here. According to the U.S. Energy Information Administration, Iran holds roughly 9% of the world's proven oil reserves. They're a founding member of OPEC. And beyond that, Iran has spent decades building what analysts call a gray market, a shadow network of oil sales that circumvents sanctions, running through intermediaries in China, Iraq, and the UAE. So even when the U.S. tries to choke off Iranian oil through sanctions, the oil finds its way out. And when tensions rise, Iran has leverage, real leverage, over global prices. Here is where it gets personal. Here is where this stops being a geopolitics lesson and starts being a money lesson. Most people think oil is about gas prices. And yes, it starts there. The U.S. Energy Information Administration has shown that a sustained $10 increase in the price of a barrel of oil translates to roughly 25 cents more per gallon at the pump. That adds up fast. If you're filling a 15-gallon tank twice a week, that's an extra $15 a month minimum just from one $10 oil move. But that's the small effect. The big effect is what happens downstream. Because oil is not just fuel. I need you to really hear this. Oil is the raw ingredient for plastics, for fertilizers that grow your food, for pharmaceuticals, for synthetic fabrics in your clothes, for the packaging around every product you buy, for the transportation of every item in every store. Oil is woven into the price of almost everything you consume. When oil goes up, the cost of producing, packaging, and shipping almost everything goes up with it. Businesses absorb that for a little while. Then they pass it to you. And that's why your grocery bill went up $15 and you didn't buy anything different. You didn't buy more. The oil just got more expensive and everything attached to it followed. Research from the Federal Reserve Bank of San Francisco has found that a 10% increase in oil prices can push core inflation up by about 0.2 percentage points within a year. Now I know 0.2 sounds tiny. But here's the thing. Inflation is already elevated. We've been fighting it. And every fraction of a percent added to inflation is another reason the Federal Reserve might keep interest rates higher. And that's where this gets really painful for regular people. Let me explain the Federal Reserve problem, because this is the part that almost nobody is talking about. When inflation goes up because of oil, the Fed faces what's called a supply-side shock. And here is the dirty secret about supply-side inflation. The Fed's main tool, raising interest rates, doesn't actually fix it. Raising rates slows the economy. It makes borrowing expensive. It cools demand. But it does absolutely nothing to solve an oil supply problem caused by a conflict in the Middle East. So the Fed is essentially trying to put out a fire with a wrench. It can't stop the oil price from rising. All it can do is slow everything else down and hope the damage is contained. What that means for you is this. If this conflict escalates and oil stays elevated for months, the Fed has a reason to keep interest rates higher for longer than the market currently expects. And higher interest rates mean your credit card balance is getting charged more every month. Your car loan is more expensive. If you were hoping to refinance your mortgage this year, that window just got smaller. If you own a small business and you're running on a line of credit, that line just got pricier. The conflict doesn't have to start a war to hurt you. It just has to stay tense. Tense and prolonged is enough to do real damage to your finances. And let's talk about what that tension could actually look like. Because I want to give you 3 scenarios, a realistic bad case, a base case, and a lucky case, so you understand the range of what might happen. The worst case, the tail risk, is that Iran makes a serious move to disrupt shipping in the Strait of Hormuz. Maybe they don't close it entirely, but they target tankers, they mine the waters, they create enough chaos that insurance companies start refusing to cover ships going through. That alone could be enough. At that point, oil could spike to $120, $140, even higher per barrel very quickly. For reference, Brent crude was trading in the $75 to $85 range heading into 2025. A move to $140 is a near doubling. At that level, you'd see gas prices spike past $5 nationally, possibly $6 or $7 in high-cost states. Airlines would cancel routes or jack up prices. Manufacturers would cut production. Global shipping costs would go through the roof. And the stock market, facing all of that at once, it would drop hard and fast. We're talking a potential 20 to 30% decline in the broader market in a worst-case escalation scenario. The base case is what most analysts are modeling right now. Prolonged tension. Oil stays moderately elevated, maybe in the $90 to $105 range. Periodic spikes on scary headlines, followed by partial recoveries when things calm down. Inflation stays stickier than the Fed wants. Interest rates stay higher longer. Consumer spending slows. Corporate earnings come in weaker than expected. The stock market doesn't crash, but it grinds sideways to lower, especially for growth stocks. It's not dramatic. It's just a slow squeeze that erodes purchasing power and investment returns over time. That's painful in its own quiet way. And the best case, the one that would make all the defensive moves I'm about to tell you seem unnecessary, is a diplomatic breakthrough. A deal, a negotiation, back-channel talks that actually result in some form of de-escalation. If that happens, oil comes back down, inflation pressure eases, and markets breathe a sigh of relief. But here's the thing about building financial defenses. You don't build them because you know the worst case is coming. You build them so that if it does come, you're not the person who has to make panicked, desperate financial decisions in the middle of a crisis. That is the whole point of being prepared. Before I give you the action steps, I need to address the biggest mistake I see people make during moments like this. And it drives me absolutely crazy because it's so predictable and so avoidable. When there is fear in the world, real, visible, front-page fear, people panic sell. They yank their money out of markets. They go to cash. They decide they'll wait until things are clear before they reinvest. And it feels rational. It feels like they're being cautious and smart. But here is what actually happens every single time. In March of 2020, COVID panic sent the S&P 500 down 34% in about 33 days. Millions of people sold everything. They locked in real, permanent losses. And then, 5 months later, 5 months, the market had fully recovered. And then it went on to more than double from that panic low over the next 2 years. The people who sold at the bottom and waited for clarity missed one of the greatest rallies in stock market history. They didn't protect themselves. They destroyed themselves because they let fear override strategy. I'm not telling you to do nothing. I'm telling you to do the right things, not the scared things. There's a huge difference. So let's talk about what the right things actually are. Step 1. Add energy exposure to your portfolio. This is the most direct hedge against what we're talking about. Most middle-class American investors are dramatically underweight in energy. They've got a lot of tech. They've got index funds that are 28, 29% tech. Energy is typically less than 5% of the S&P 500. In a crisis driven by oil prices, that underexposure becomes a real problem. When oil goes up, energy company profits go up. Their stock prices go up. So if your portfolio has zero or minimal energy exposure, you have no shock absorber when oil spikes. The good news is you don't have to pick individual stocks to fix this. You can simply add an energy ETF, a fund that holds a basket of energy companies, and get broad exposure in one move. XLE is the Energy Select Sector SPDR fund. It holds companies like ExxonMobil, Chevron, ConocoPhillips. VDE is Vanguard's energy ETF, slightly broader. Either one gives you exposure to the companies that benefit when oil prices rise. You don't need to go all in. 5 to 10% of your investable portfolio is a reasonable allocation. Think of it like a seat belt. You put it on not because you plan to crash, but because if you do, you're glad it's there. Step 2. Consider a position in gold. Now I know gold gets dismissed a lot. People call it a relic, a fear trade, an asset that pays no dividends and just sits there. And in calm, growing markets, they're not totally wrong. But in moments of genuine geopolitical instability, gold does exactly what it's supposed to do. It holds value. It goes up when everything else is panicking. Look at every major geopolitical crisis in the last 30 years. The Gulf War, 9/11, the 2008 financial crisis, COVID. In every single one of those moments, gold either held steady or surged while equities fell. You don't need to go buy gold coins and bury them in the backyard. Although, honestly, there are worse ideas. You can buy gold through an ETF. GLD and IU are the two biggest gold ETFs, and they're liquid, low cost, and easy to buy in any brokerage account. 5 to 10% in gold, combined with your energy exposure, starts building a portfolio that can actually absorb a geopolitical shock without forcing you to make panic decisions at the worst possible moment. Step 3. Move your cash savings into a high-yield savings account. This one is simple, and people still aren't doing it, and it genuinely frustrates me. Right now, high-yield savings accounts and money market funds are paying between 4 and 5% annually. Traditional big bank savings accounts are paying 0.01%. If you have a $20,000 emergency fund sitting in a Chase or Bank of America savings account, you are earning $2 a year. With a high-yield account at the same $20,000, you'd earn around $900 a year for doing literally nothing except moving money from one account to another. That's $900 of free money you're leaving on the table every single year. In an inflationary environment where every dollar matters, this is unconscionable. Move your cash today. Step 4. Consider I-bonds. I-bonds are inflation-protected savings bonds issued by the U.S. Treasury, which means they are backed by the full faith and credit of the United States government, about as safe as it gets. Their interest rate adjusts with the Consumer Price Index. So when inflation goes up, the rate on your I-bond goes up automatically. You can't buy them through a regular brokerage account. You buy them directly at treasurydirect.gov. The catch is there's a $10,000 per person per year limit. But for what they are, a guaranteed, government-backed, inflation-adjusted investment, they deserve a place in your strategy right now. If oil prices drive inflation higher, your I-bond rate follows it up. Boring? Absolutely. But when inflation is the threat, boring is the move. Step 5. Ruthlessly pay down high-interest variable debt. This is the one step nobody wants to hear, but it might be the most important one. If you're carrying balances on credit cards, which, by the way, according to the Federal Reserve, the average American household carrying credit card debt owes over $6,000 on those cards, and those cards are charging you 22, 24, 26% interest, you need to attack that debt aggressively right now. Because if the Fed keeps rates higher for longer due to oil-driven inflation, those variable rates creep up even further. Every dollar of that debt is a guaranteed loss. No investment you make in the stock market gives you a guaranteed 24% return. Eliminating 24% debt is the equivalent of a guaranteed 24% gain. Start there. Minimum payments on everything else avalanche that high-interest debt. Step 6, and this one is for the business owners, the freelancers, the self-employed people watching this. Review your supply chain and your pricing right now, not in a month, not after you see how things shake out. Now, if your business depends on transportation costs, on goods shipped by sea or air, on any petroleum-based inputs, plastics, packaging, synthetic materials, your cost structure is about to get more volatile. The businesses that survive inflationary supply shocks are the ones that move quickly. They lock in supplier pricing where possible. They review their own pricing strategy and raise prices before costs force their hand rather than after. The businesses that absorb the cost increases quietly and hope they go away are the ones that end up underwater 6 months later. Don't be that business. Get in front of it. Now let me talk about something that doesn't get discussed enough in the context of geopolitical uncertainty, and that's the emotional dimension of financial decision-making. Because here's the truth. Most financial mistakes aren't made because people don't know what to do. They're made because people know what they should do, but they feel too much fear or too much greed to do it. The Iran conflict, the news alerts, the military posturing, the price spikes, creates a specific kind of financial anxiety. It feels urgent. It feels like you need to do something dramatic right now, or you're going to lose everything. That urgency is exactly when you make the worst decisions. Selling everything, moving to cash at the bottom, buying into a panic trade at the exact wrong moment. The people who actually protect and grow wealth during crises are not the ones who act fastest. They're the ones who act calmly, from a place of preparation rather than panic. That's what the 6 steps I just gave you are for. They are not exciting. They are not dramatic. They are the boring, strategic moves that look incredibly smart in retrospect. Think of it like this. You don't decide to put on your seatbelt after the car starts skidding. You put it on before you leave the driveway. The conflict is already in motion. The price effects are already showing up. But it's not too late to buckle up. It's just late enough that you need to move with intention. Let me bring this all together. Here is the honest truth about what we're facing. The US-Iran conflict is not a headline that lives in a box on your phone screen. It is already a material, real-world financial event that is affecting gas prices, grocery prices, inflation, interest rates, and investment portfolios. The Strait of Hormuz is the jugular vein of global energy supply, and the fact that it is controlled by a country in open conflict with the United States is not a trivial geopolitical footnote. It is a core variable in the price of almost everything you consume. The 3 scenarios I laid out for you, worst case, base case, best case, are not speculation. They are the actual range of outcomes that oil markets, geopolitical analysts, and institutional investors are actively pricing right now. And the 6 steps I gave you: energy exposure through XLE or VD, a gold position through GLD or IU, moving cash to high-yield savings, buying I-bonds, eliminating high-interest debt, and reviewing your business cost structure, are not abstract ideas. They are concrete, actionable moves that you can execute this week, some of them today. You don't have to do all 6 at once. But I want you to pick at least 2 right now, before you close this video, before you scroll to the next thing, before that uncomfortable feeling fades, and you tell yourself you'll deal with it later. Because later is how people get caught unprepared. Later is how the guy who saw the gas prices going up, who felt that dread at the pump, still ends up getting financially blindsided because he never connected the dots to action. You watched this video. You connected the dots. That already puts you ahead of most people. Because the uncomfortable truth about financial crises is that they don't hurt everyone equally. They hurt the people who weren't paying attention. They hurt the people who let "I'll figure it out later" become their financial strategy. And they reward, quietly, steadily, without any drama, the people who saw it coming and made calm, rational moves while everyone else was still debating whether it was real. You saw it coming. Now make the moves. Go check your savings account rate. Go look up XLE or GLD. Go log into treasurydirect.gov. Do something concrete with what you just learned. Because information without action is just entertainment. And your finances deserve better than that. If this gave you clarity, share this video with someone you care about. Because a lot of people are feeling that tightness at the gas pump and they don't know why. and they don't know what to do about it. Now you do. Be the person who helps them understand it. I'll see you in the next one.